Ever wondered what it means to play the bear in the stock market? To bet on a stock's decline rather than its rise? Welcome to the intriguing world of short selling, a strategy that requires a solid grasp of a unique lexicon. Let's untangle this web of terminology together. Imagine a towering fortress, its sturdy walls built from blocks of short position, margin account covering a short interest, short squeeze, hedge, and regulation show. Each term is a cornerstone that upholds the structure of short selling. Picture a short position as the cornerstone of this fortress. It's when an investor borrows shares of a stock, believing it will decrease in value. They sell these borrowed shares at the current market price, only to buy them back at a lower price in the future. This is the heart of short selling, profiting from a stock's decline. Now imagine a margin account as the battlefield within this fortress. It's a special type of brokerage account that lets the investor borrow money or stocks from the broker to make investments. It's crucial because it provides the leverage needed to open a short position without the full capital usually needed to buy stocks. Covering a short is the final move in the short selling game. It's when the investor buys back the borrowed shares and returns them to the lender, ideally at a lower price than they sold them for. It's the moment of reckoning where the success or failure of the short selling strategy is revealed. Short interest is the scout that gauges the size of the battlefield. It represents the total number of shares that have been sold short but haven't yet been covered or closed out. High short interest can signal that investors are heavily betting against a stock's future success. A short squeeze is the surprise attack that can catch a short seller off guard. It happens when a stock with high short interest starts to rise in value, often quickly, forcing short sellers to buy shares to cover their positions and limit losses. This buying can drive the stock's price even higher, creating a vicious cycle that can lead to significant losses for short sellers. The hedge is the shield that can protect investors in the midst of market volatility. It's an investment made to reduce the risk of adverse price movements in an asset, acting as insurance against potential losses. In short selling, a hedge might involve taking a long position in a related stock or sector to offset potential losses from the short position. Finally, regulation show is the law of the land in the realm of short selling. It's a set of rules established by the SEC that provides the framework for short selling, ensuring transparency and fairness in the market. It includes provisions to prevent abusive short selling practices and to maintain orderly market conditions. In essence, short selling is a complex strategy that involves borrowing stocks, selling them, and then buying them back at a lower price. It requires a margin account for leverage, and the process of covering a short determines the strategy's success. High short interest can indicate a bearish sentiment, but a short squeeze can turn the tables quickly. Hedging can offset potential losses, and regulation SHO keeps the game fair and transparent. As with any financial strategy, understanding the terminology is the first step to mastery.